What's up, everybody? Welcome to Heresy Financial. My name is Joseph Brown, and today we're looking at the fact that the market really seems impervious to any bad data that comes out. Nobody has jobs, no problem. The trade deal's not going to happen, no problem. Coronavirus cases are spiking, no problem. So why does the market continue to rally? Why does it continue to shrug off all the bad news? Good questions. Let's dive in. If you haven't already, I highly recommend the video that I made recently about my price targets for the rest of the year, because I explain some of my price targets that have already started to unfold for the rest of this year, such as we're going to see a melt up in the stock market and gold is going to break out and gold mining stocks are going to break out and the dollar is going to fall. We've seen a huge increase in bearish sentiment, and I want to throw up a chart here. If you're not familiar with this gauge, it's a really fun gauge to watch day in and day out because it measures through a number of different factors in the market the amount of fear or greed that is going on in the market right now. Now take a look at this, because this is a short, just last couple of years, a chart of what the score has been on this fear greed sentiment index, the indicator here. And you can see that, back in February, right before the market started to crash, that greed level was at near an all-time high there. It was right up pretty much at as high as it can be there, near 100. And then as soon as the market bottomed out March 23rd, this fear indicator was really low towards the bottom here. So it's pretty good in terms of its nature to be a contrarian indicator. And that's kind of what Warren Buffett talks about a lot, right? When people are fearful, you be greedy, and when people are greedy, then you be fearful. Because as the sentiment, the overall trading and investing sentiment is at its height of greed, that usually indicates that you're at the top of a bubble or a bull market. And as the fear is at its peak and everybody is the most bearish, usually that's an indication that you're pretty much at the bottom and things are going to be looking up from there. Now, I want to reiterate that my price targets and my outlook for what asset prices and the markets are going to do is doesn't have any relation to my view of the health of the economy. In fact, I think they're pretty much the opposite. The stock market is going to have this melt up, this FOMO rally here, regardless, and in fact, in spite of the bad economic data. And this week has been pretty much proof of that the market is prepared to shrug off any amount of bad data that comes out. We see jobless numbers being worse than we expected them to be. We see states contemplating shutting down again because of the coronavirus spikes. We see coronavirus spiking. So we see, what are businesses going to do in response to this? We also see the trade deal talks, not happening, and then they're happening, and the bad data is coming out left and right, but the market is resilient against it. Now, here's the main reason why it's all priced in at this point. All of the bad data that we've seen has not been a surprise. Yes, there are consensus estimates on what certain numbers might be, but from the beginning, before mainstream media had even spoken the word coronavirus, people who were watching the coronavirus start to unfold in China that were not a part of mainstream media were already talking about how things like this tend to come in waves. And the same thing happened with the Spanish flu 100 years ago. There was a first wave and the second wave was worse. And so it's pretty logical, right? If you have something, a pandemic that's unfolding, everybody withdraws, that's going to stop the spread from happening, but it's not going to cure the disease, right? It's not going to cure the sickness. So once people start to go back out and resume their lives, you're going to have a big tick up in the amount of cases again. So it's not going to heal. It's not going to cure it. It's going to slow it down while that social distancing is taking place. And as soon as that stops, it's going to resume its rise upward. And so none of this has been a surprise. Even the jobless numbers, yes, it was a little bit more than expected, but ultimately, it's not a surprise in the sense that the initial jobless numbers were when they first started coming in. Those were big surprises. Those were big, way more than anything that anybody could have expected. Worst jobless numbers in history. Further than that, the Federal Reserve and the government have made it abundantly clear. No matter what happens, they are 100% committed to kill the dollar on the altar of the facade of the economy fixed on the stock market and the asset bubbles. 100%. The Federal Reserve will print an unlimited amount of money to maintain asset prices. regardless of the monetary consequences, regardless of what that does to the cost of living, regardless of whether that turns the entire world into Zimbabwe, Argentina, the Weimar Republic in Germany, or Venezuela today. And investors know this. And so anytime there is anything that is slightly bad news, or they know even if something is massively unexpected in terms of how bad that data point is when it initially comes out, they know that there's Big Brother, Uncle Sam, with his unlimited blank checkbook ready to write a check for whatever is necessary to bail out the economy. The everything bubble starts to pop and is met with the everything bailout. And so yes, we've had some bad economic data come out. The stock market has pretty much shrugged it off. And so any good data that comes out, even if it's wrong, even if it's false, manipulated, any new expectations come out of another stimulus bill getting through or an infrastructure bill getting through, anything like that happening, that's going to push the markets up higher and faster and higher and faster until we get to the point where everybody who got shaken out in March and everybody who sold and are now looking at this and thinking, no matter what, the markets are going to go up, no matter what bad news comes out, no matter how many people don't have jobs, no matter what the trade deal and tariffs look like, no matter what, the stock markets still go up. I'm going to put every last dime that I have into that stock market because everything else is getting expensive too. Not just asset prices, food prices are skyrocketing. Gas will start skyrocketing. The cost of houses might start skyrocketing. So everything is skyrocketing. I'm not going to leave my money in cash because everything is running away from the purchasing power of my cash. So I'm going to do the easiest thing possible. I'm going to put every last dime into the stock market because clearly nothing can make it go down. Stonks always go up. And that will be that FOMO rally, that last euphoric phase before the eventual collapse that I think will happen after the election. And the nice thing is, you don't have to agree with the Federal Reserve. You don't have to agree with the Treasury or Congress or the president. You don't have to agree with Keynesian economics or Austrian economics. You don't have to agree with anyone. You don't even have to bet on one prediction or another. You don't even have to be right about what you think the market will do. I love what Robert Kiyosaki says about this. He says, I'd rather be profitable than right. And fortunately with trading, you don't have to just sit on the sidelines. You don't have to just watch the markets run away from you. You don't have to just sit there and whine and complain about the markets being rigged and manipulated. You can make, even if you disagree with all of what's happening, you can still make money on it. I can still ride the wave up and hedge myself and protect myself so that if everything crashes, I make money if it goes up, I make money if it goes down. Let's say everybody's wrong and somehow the markets just move sideways. They don't go up, they don't go down, they just stay in a really tight channel. You can make money from that too. So that's my strategy, that's my outlook. Yes, I study economics and I study history to be able to determine what the proper course of action should be. But if that doesn't happen, what will probably happen as a result of mistakes made by policymakers, both monetary and fiscal policy. And I make money off of it. And then if I'm wrong, I'll still make money. It's heads I win, tails I also win. Now, if you're just trading stocks and ETFs, to do this, just make sure you're being careful. You can use things like stops and limits and trailing stops and brackets and conditional orders, all of the fancy stuff you can do throughout the day to make sure that you're protecting yourself. You want to get a little bit more advanced, you can use shorts as long as you're not shorting something that's hard to borrow like Hertz that you're not going to be able to find shares to borrow in order to short. But you can always find shares to borrow of things like major ETFs like SPY, so you can short to play the downside. Stay away from leveraged or inverse ETFs because the beta slippage on those is as long as don't trade them for anything longer than day trading. Don't hold those things overnight because the beta slippage on those, even if you're right and the underlying moves in the direction you thought it would, a lot of times the leveraged and the inverse ETFs will continue to trend downwards long term. But if you want an intro into something that's even more advanced and lets you play both the upside and the downside and the neutral sideways movements of things, use options. It's not a recommendation. If you want to learn, you can learn how to use options to trade like that. My options course is linked in the description below. Thank you so much for watching. If you enjoyed the video, please like, subscribe, share. It really helps the channel out. You guys are the best. Have a great day.